I'd like to reconvene the meeting, please. Okay, welcome back, everyone, and I hope you had a nice lunch break. Now we'll turn our attention to the global markets. Ben and Lorene, please introduce your guests.
Thank you, President Jones. Good afternoon, everyone. I hope you all enjoyed your lunch. For the second day of today's session, we are going to shift gears to get an understanding of the global economy and market valuations from the public market perspective. We have with us today a very distinguished panel who will share their thoughts on the state of the economy and their insights on market opportunities over the long run. The timing of this discussion is perhaps opportune in light of the volatility and uncertainties that the market have experienced over the past few months. Moderating the discussion this afternoon will be Lauren Roseborough-Watt, an investment manager at CalPERS, who serves as the economist for the international fixed income portfolio. Before joining CalPERS in 2017, Lauren was a senior advisor for the central bank in New Zealand. And earlier in her career, Lauren worked for a variety of corporate and commercial banks in London and New Zealand, and was a regular business media commentator and has been regularly quoted in the Financial Times and the Wall Street Journal. So with that, I will hand over to Lauren to introduce our distinguished panelist.
Thank you. It is my privilege to moderate this panel discussion today. And before I introduce our panelists and then let them talk around the topic of the global economy and market valuations, and then open up the discussion for questions from yourself or comments that you might have, I wanted to put today's topic into context. And you heard earlier on this morning from the esteemed Howard Marks, and no doubt you've read his book regarding market cycles. And within that, and he had a slide talking about the long-term trends that the economies can go through, and overlaid on top of that the cyclical or the short-term oscillations around that trend. It's those short-term oscillations that we'll be talking around today. And when I say short-term, I mean the business cycle. And that can be anywhere between 3 to 5 years duration, or at the moment, in the US, we're 9 years knocking on 10 years of expansion. So the panelists today will be talking around where they see the US and global economies at present, and also where they see these economies going over the short to medium term. The intent here is to try and draw out and understand some of the risks and opportunities that CalPERS can, capitalize upon. Also, some of the implications for us as investment officers in terms of CalPERS asset allocation. So without further ado, let me introduce you to our panelists. We have Mr. Joachim Fels here, Managing Director and Global Economic Advisor for PIMCO in Newport Beach here in California. He's a member of the Investment Committee and Executive Committee. He also leads PIMCO's quarterly cyclical and sectoral forum process, which I have a copy here I print out as soon as it becomes publicly available. Prior to his role at PIMCO, he was Global Chief Economist at Morgan Stanley, worked at Goldman Sachs, and began his career at the Kiel Institute for the World Economy. Sitting beside him is Mr. Rick Reeder, Managing Director of BlackRock, BlackRock's Chief Investment Officer of Global Fixed Income, also co-head of BlackRock's Global Fixed Income Platform, a member of BlackRock's Global Operating Committee, and chairman of the firm-wide BlackRock Investment Council. Prior to his role at BlackRock, he was Chief Executive Officer at R3 Capital Partners. He also holds a number of advisory roles for publicly traded companies. And earlier in his career, he worked at Lehman Brothers and SunTrust Banks in Atlanta. Our third panelist here is Mr. John Rothfield, Investment Director and Portfolio Manager for Global Fixed Income and US Treasuries here at CalPERS. John is involved in the Investment Strategy Group, the ISG we call it. He's also a voting member of the Portfolio Allocation Subcommittee. And no doubt many of you will recognize him. He's frequently here in front of the board. Prior to joining CalPERS in 2012, John worked in many senior roles at Bank of America Merrill Lynch, both here in the US and in Australia, and he began his career at the Australian Treasury. So to begin, Mr. Fells.
All right. Well, thank you, Lauren, for the introduction. Thank you for having us here. It's a pleasure and a privilege to be here in front of the board. Now, my colleagues at PIMCO and I have a regular dialogue with CalPERS investment professionals, with Lauren, with John, with many others. Your new CIO, Ben, and I last met in Beijing when he was at SAFE, I think 2 years ago, Ben, so it's great to see you again. Even though we have this regular dialogue with CalPERS investment professionals, this is my first time in front of the board, so thank you very much for having us. I want to spend the roughly 20 minutes, 25 minutes that I have talking about three things. The first thing is I want to talk about the economic outlook for this year, for 2019, what we call the cyclical horizon at PIMCO, cyclical 6 to 12 months ahead time horizon. Then secondly, I want to talk about the longer-term outlook, what we call the secular outlook, which is the next 3 to 5 years in our perspective. And then I'll end up with a few very high-level remarks on investment conclusions. And by the way, maybe I'll give you a short glimpse at the conclusions at the beginning. So up front, just tell you where I plan to be heading in the course of the next 20 minutes. So we think that this is a time for caution for investors. We are in the later stages of the economic and the market cycle. And while a recession is not imminent in our view, we think that in this phase of the cycle, investors have to face higher economic uncertainty and higher financial market volatility. And I think we've started to see this playing out already in the last year or so, and particularly over the last 3 to 4 months in financial markets. So in our view, investors who just extrapolate from the experience of the last 5 to 10 years, the post-crisis period, which was a period of fairly steady growth and very low market volatility, investors who extrapolate from the last 5 into the next 5 years will be in for some rude awakenings. And I say rude awakenings because that was the title of our longer term, the secular outlook, which we publish once a year in May of each year. And the last one was entitled Rude Awakenings. And I'll say more about that a little bit later. So in this environment, we think that investors should focus even more than usual on capital preservation. So much more than usual, this is a time to focus on the return of capital rather than the return on capital. Now, both is important, of course. The return on capital, we all want and have to. You have to earn a yield on your portfolio. But capital preservation, the return of capital, is also a very important goal. And in this market environment, we think it is an even more important goal. So that's why we recommend to focus on more liquid and high-quality assets that do well when things get rough. And we also focus on a globally diversified portfolio, globally diversified sources of yield, so to speak, that should remain resilient even in adverse economic scenarios. So that's the overall, the high-level view in a nutshell. And let me now give you some reasons for why we think so. So, as I said, the first thing I want to do is focus on the economic outlook for this year, economic prospects for 2019. The first question is, where do we stand? What are the initial conditions? I have a few charts in here, but I don't want to spend too much time on the charts. So I'll just have some of them running in the background. I hope you will be able to follow what I say without necessarily looking at the charts. So the first thing to say is that peak growth is now behind us in the global economy. We've seen China slowing, we've seen Europe slowing, we've seen the Japanese economy slowing since about the beginning of last year. So this is not a new thing. We reached peak growth for the global economy, for global GDP, roughly at the turn of 2017, 2018. And since then, the global economy has started to slow. The US was an exception in a way, because we had a big fiscal boost that propelled growth, particularly in the first half of last year. But even in the US, we are seeing growth slowing since the peak that we reached in the second quarter of last year. Inflation has been notable for its absence, and this is not new. This has been the case for most of this cycle. Yes, we had some pickup in overall consumer price inflation and headline inflation, as we call it, because oil prices last year, energy prices rose until early October of last year. They rose quite sharply, so this has been pushing inflation higher. But if you look at inflation adjusted for energy prices and for food prices, which are the more volatile components in the consumer price basket, you will see that core inflation, which is this adjusted inflation measure, has been broadly flat. As you can see that in the right-hand charts. This is true in most major economies. I like to say inflation, core inflation, has been flat like a pancake. And we'll come to the outlook for inflation in a minute. Policy rates, which is what central banks control. Policy rates last year went up around the world. The yellow line in the left-hand chart shows you that many emerging market central banks had to raise interest rates because their currencies were under pressure. Their currencies depreciated, so they had to raise interest rates to defend them. In the developed market economies, which is the blue line in the left-hand chart, the bottom line, it was really only the Fed and a couple of other central banks that raised interest rates last year. So overall, we've seen policy still fairly expansionary, but gradually tightening. And if you look at the right-hand chart, once you adjust these official interest rates, like the Fed funds rate in the US that the Fed controls, once you adjust them for inflation, you look at real interest rates, real short-term interest rates, they've been pretty flat almost everywhere except in the United States, where they have been rising because the Fed hiked rates 4 times. So that was the story of last year. These are the initial conditions. Importantly, what we saw in the course of last year was a very significant tightening in financial conditions. What do we mean by this? Well, if you look across financial assets, across financial markets, US financial conditions tightened because, first of all, the dollar appreciated last year, which is a drag on exports, and to some extent also on investment in the United States. We had, for large parts of last year, at least until the beginning of the fourth quarter, we had rates rising. So not only did the Fed raise interest rates, but bond yields also increased in several steps. And more recently, in the fourth quarter, finally we had equities falling. What is not in the charts is a widening of credit spreads, which also is a tightening of financial conditions. And the important thing here is, while this tightening has already happened, we still expect to see the negative fallout from this tightening of financial conditions on the real economy, on growth, to come through over the next several quarters, because there is a time lag between a tightening of financial conditions and a slowdown in growth. So this is something that we still expect to play out. So that brings me to our cyclical theme for this year. It is sinking lower, and sinking written with a Y. Now, why is that? Well, this is because we think this is the year, this is going to be the year 2019, when the US economy resynchronizes or catches down to the rest of the world in terms of growth. Now, last year, US growth was exceptional, as I already mentioned. This year, we think the US will slow more than other economies, which have already had a significant slowdown in the course of last year. So we think this year will be almost the exact opposite of what we saw back in 2017, 2 years ago. That was the year of the globally synchronized acceleration of growth. Everybody did better. Growth rates accelerated everywhere. Then 2018 was a transition year when global growth peaked and started to slow, as I said, but it also started to diverge. China, Europe slowing, the US still growing strong and actually accelerating because of the fiscal boost. But this year we see the US slowing, partly because of the tightening of financial conditions that I mentioned, but secondly also because the fiscal stimulus will be fading in the course of this year. And there's a third reason, which has to do with the sharp drop in oil prices we saw recently, which benefits other economies much more than the US. Now you may say, why is that? When gas prices go down, we as consumers all benefit. That's right. But the US these days, the US economy these days produces virtually all of the energy that it uses. So what our consumers gain comes out of the pocket of US energy producers. It's basically going from one pocket into the other pocket. The economy overall doesn't really gain from lower oil prices, and we saw that back in 2014, early 15, when oil prices dropped very sharply, and the economy didn't respond positively because the oil producers, the energy producers in the US slashed their investment spending, and consumers just pocketed the windfall gain from lower gas prices and only started to spend it much later. So that's why we think the US will be sinking down or catching down to the rest of the world in the course of this year. That's the overall theme. Now, further on the outlook for this year, we think there are 5 key questions or 5 key debates that will shape the outlook for the economy and for markets this year. And let me just go through each of them for a minute or two. The first one is maybe the most important one, and it's been much debated in the last several months in financial markets and in the press. So the question is, how late is it really in the cycle, in the US cycle? I mean, we all know, and Lauren already mentioned it in her introduction, this will soon be the longest economic expansion in US modern economic history. If this expansion lasts beyond June of this year, it will become the longest. It will become 10 years old, and the longest so far was 91 to 2001, which was the longest expansion so far. That's what people mean when they say, well, we're in the later stages of the cycle. However, I think it's important to differentiate between late cycle and end cycle. So while we are in the late stage of the cycle, we think we're not at the end yet. A recession is not around the corner. If this expansion was a tennis match, they're playing the Australian Open at the moment, down under, and John is from Australia. So if this was a tennis match, then I would say we're at the beginning of the 5th and last set. But down at the Australian Open, they don't play a tiebreak in the last set. So this could go on and on. It could become a very long last set. Why is that? Well, why do we not think that the recession is imminent? Well, one reason for saying so is because that's what our quantitative models tell us, and I won't go into details here, but the upper left-hand chart shows you the result of a range of such models that spit out recession probabilities. So we throw a lot of data into the model, and we ask the model, how likely is it that we get a recession over the next 12 months? And the model tells us at the moment around 30%. This is why that blue line on the top left-hand chart has spiked up. So the models say there's a 1 in 3 chance that we get a recession, declining GDP growth, declining GDP, shrinkage in GDP over the next 12 months. So 30% is not 50% or higher, so we're still lower than we were ahead of past recessions, but it is the highest probability that the models produce in this expansion. So that's why we say the lights, the warning lights are flashing orange, but not yet red. Now, you should never trust in a model alone, but our qualitative assessments would also support the notion that the recession is not around the corner, and you see some of those on the right-hand part of that slide. For example, we're not seeing the overheating in the economy that has often occurred before past recessions. That's then usually when the Fed had to raise interest rates aggressively to fight inflation. And as we all know, expansions don't die of old age. They usually die because somebody murders them. And in the past, that has often been the Fed, right? But this time around, there's really no need for the Fed to get aggressive. Secondly, we're also not seeing the overspending or overborrowing that we had ahead of past recessions. The US consumer is more cautious. The saving rate, the personal saving rate, is more than 6%. It dipped negative before the last recession when everybody was using their home as an ATM. The corporate sector has also been more cautious in its spending. So companies have not overinvested. If anything, they have underinvested in this expansion. So there are no major excesses out there. Two caveats to that. The first one is, well, you know, it doesn't take an economic recession to create turmoil in financial markets. And I'll give you one example, again, from down under, Australia. Australia is well known for not having had a recession for the last 27 years. Right? We will celebrate the 10th anniversary of this expansion in the middle of this year, but Australia hasn't had negative GDP growth since the early 1990s. However, if you look at the bottom part of this chart, this shows you declines in equity markets, or drawdowns, you know, as we say. And you can see that even though Australia didn't have a recession, they had a few pretty big drawdowns, a few pretty big declines in equity prices. And one of them in 2008, when obviously we had the global financial crisis, was down 50%. So you can have pretty bad financial market outcomes even in non-recessionary environments. That's the first thing to remember. The second thing to remember is even if there are no imbalances in the real economy, it may well be that a derating of financial assets is the thing that brings down the economy. We have a highly financialized economy. In other words, the economy is very dependent on financial conditions. So if we were to get a major downturn in financial asset prices, for some reason, it could be an external shock, or it could be a policy shock, or a geopolitical shock, then this is basically the wagging of the tail that could bring down the dog, that could bring down the real economy. So there is reason for caution, even if we don't see a recession around the corner. The second debate, I will not spend much time because I've already answered that. So the second question is, will US economic exceptionalism come to an end this year? And I already said the US economy was exceptional last year, stronger growth. The Fed was the only major central bank that raised interest rates 4 times. The dollar appreciated. US equities outperformed, at least until the beginning of the fourth quarter. Now, our answer to the question is yes, and you've heard me explain why earlier. We think this year the US will look a little bit more normal, a little bit more like the rest of the world. And this could have important implications. For example, it could mean that the dollar appreciation could stop. And the dollar might even turn this year. Now, nobody knows because forecasting currencies is like, or exchange rates, like flipping a coin. That's what Alan Greenspan used to say, and I think he was right, at least on this one. But if the dollar turns, it would have important implications, because if the dollar turns, then this could help particularly emerging market assets, which usually don't do well when the dollar appreciates. We saw that last year. And so this year, you know, we might see emerging markets starting to outperform. We can go into this in Q&A later. Third key question for this year is, will inflation ever return? And I'll give you a very short and very precise answer. Yes and no. This is like an economist, right? Two-handed economist. The yes is, we think wage inflation is about to return. Not only in the US, but elsewhere. You look at the left-hand chart, and wage growth, nominal wage growth, is picking up almost everywhere. And what's even more important for consumers, not only are wages growing more strongly, but also inflation, headline inflation is coming down because energy prices are coming down. So real wages are increasing even faster. So that's good news for the consumer. But we think this will not translate, at least not this year, will not translate into any significant pressures for consumer price inflation. There are global competitive forces that keep consumer price inflation low. Also, the stronger wage growth, which is a cost factor or can be a cost factor for companies, is compensated by a pickup in productivity growth. So workers are not only earning more, they're also becoming more productive. And so for companies, you don't get the same kind of unit labor cost pressures, as we call them, as you would expect. So consumer price inflation is still relatively low. Longer term, when we think 3 to 5 years out, we think there are some inflation risks, but we can come back to them later also in the discussion. And then quickly, how much time do I have, Lauren? 5 minutes? Good. So debate number 4, the Fed pauses. I think that's clear by now. The Fed has signaled very clearly after the volatility in markets in the fourth quarter that they are pausing with rate hikes. But the question is, what happens thereafter? And the markets now seem to think that the next step is more likely to be a cut in interest rates than a hike. For 2020, the market is pricing in the rate cut. We think that the market may have run a little bit ahead of itself, but not too much. So our view is that we are either at or close to the end of the rate hike cycle. We think it's more likely than not that the Fed maybe hikes rates once again, June at the earliest, or then in the second half of this year. But the bigger picture story is that policy is now pretty close to what we would call neutral. PIMCO has had this view for many years now that we are in a new neutral environment where the neutral rate of interest is much lower than in the past. Neutral meaning the rate of interest that neither hinders nor supports growth. So where growth can be at about trend and where inflation can be about at target at 2%, we're now pretty close to that neutral rate, and the Fed is acknowledging that. Therefore, I think we're now in a phase where, in a new phase for the rate cycle, the 9 rate hikes are behind us. There is one more coming. But by and large, we should look for a prolonged period of relatively unchanged interest rates. And then fifth and last debate is US versus China. What about the trade conflict? Well, we think that it's now quite likely that we will get a deal on trade between President Trump and President Xi in the next few weeks, definitely before March 1st, which is the deadline that the US has set. However, we think the underlying trade tensions will continue, because this is not only about the bilateral trade deficit, which is what President Trump is very focused on, it's also about intellectual property, potential intellectual property theft, and it's about the fact that China as a rising power is challenging the global dominance of the US, not only in economic terms, but increasingly also in political terms. So there will continue to be an underlying source of tensions. And talking of trade tensions, we also think that investors are probably underestimating the risks that are still out there for NAFTA tensions again, so the North American Free Trade Agreement. As you know, there's a deal, NAFTA 2.0, which is called USMCA, which was negotiated, but that deal has not yet passed Congress, and the Democrats are not particularly keen on that deal. And there is a risk that President Trump decides to withdraw from the existing NAFTA agreement in order to force Congress to pass the new NAFTA. And so that could create volatility and uncertainty given our trade ties with Mexico and with Canada. And then there's also a risk that the next target of the US administration will be Europe. And there's a very good chance or a very good risk that the US imposes tariffs on auto imports and imported auto parts in order to bring Europe to the negotiating table. So trade tensions will continue creating uncertainty. And so with that, let me just make one or two comments on the long-term outlook, if I still have a minute or two. Do I? Yeah, okay. So I come back to what I said at the beginning, the rude awakenings that we would expect for investors who just extrapolate from the last 5 into the next 5 years. We think we're really at an inflection point in terms of in the longer term cycle. And let me give you a few examples of potential rude awakenings that investors have to be prepared for. First of all, while a recession is not around the corner, we think if you take a longer term view, next 3 to 5 years, it's quite likely that we hit the next one. And then we will have less tools available to fight that next recession than we had in the last recession. So the next recession may not be as deep as the previous one. The previous one was exceptionally deep, but it may be more prolonged. It could be shallower, but longer. Second worry that I would mention is about the shift in the monetary and fiscal policy mix. So monetary policy in the last 10 years was extremely supportive, extremely expansionary. Fiscal policy was largely passive and restrictive, or restrictive, depending on which country you look at. Now this is changing, so the Fed has tightened policy. Also other central banks in Japan, in Europe, have virtually no room to become even more expansionary because they haven't really built any ammunition. They're still at negative interest rates and they still have very large balance sheets. So in the next downturn, you will probably see fiscal, if any policy area can react, it's fiscal policy. Fiscal policy is a much stronger tool to influence demand and inflation than monetary policy. Monetary policy is often like pushing on a string. We learned that. So if fiscal policy becomes more expansionary, then there are bigger inflation risks further down the road, right? Because it is a much more direct tool. And then the last potential rude awakening that I'll mention is on the political front. I mean, everybody knows about the trend towards populism that has been underway in the last several years, including in this country. We've recently had elections in Brazil and Mexico where populist candidates, populist presidents were elected. Our worry is that over the next 3 to 5 years, we may see a different kind of populism coming up. A form of populism that is much less market-friendly than the previous one, because there are underlying problems that are still not being addressed in the global economy, which are rising inequality, for example, income and wealth inequality. And I think you may well see the next wave of populism trying to directly address this through much more massive wealth and income redistribution from high income earners to lower income earners, from the wealthy to the less wealthy. And while this may be desirable from a society and even from a longer term economic point of view, if it doesn't get overdone, I think financial markets will not react positively to this different kind of populism that could happen. It would probably also go hand in hand with much tougher regulation and even with nationalization of certain industries, maybe not in the US, but in some other advanced economies. So on that merry note, and because I've used up my time and given my investment conclusions at the beginning, I'll just stop here and happy to take questions later. Thank you.
Thank you, Joachim. That's a lot to mull over and ponder about, and I certainly have some questions later on that I'd like to draw out some of those thematics a bit further. Before we do ask questions, I want to move through our panelists, and then we'll open it up for the floor. So, Rick.
Thanks, Lauren. Thank you all very much for, this is also, as Joachim said, my first time presenting here, so it's a great honor. Appreciate the invite. I also use, as Ben and I were talking about earlier, I use a lot of graphs and tables. And so we said I got to talk about the fixed income market, the broad economy. I have about 150 pages, so I will be here for 2 or 3 hours. And then Lauren said 20 minutes, so here we go. I cut it down quite a bit. Anyway, what I'm going to try and get at, I think there are 5 or 6 main themes and that I'm going to try and draw out. And I know part of why you construct a panel is you're trying, there's also controversy and difference of opinions. Joachim and I have pretty similar opinions, so I won't, I'll try not to spend too much time on what Joachim already well covered. But I'm going to try and hit 5 or 6 main topics, and I'm going to get to asset allocation and talk about how I think these drive the asset allocation decision, and maybe throw out some food for thought about where and how to think about investing today. So if you go to this first page, so this is, I tried to break the record early by having 5 graphs on a page and about 50 lines of text. Let me talk through it, and part of this is all getting one theme on one page. The biggest theme that I think is, quite frankly, I think this is the biggest influence on markets now, bar none, and that is the dynamic around liquidity being pulled out of the system. You never see it, you don't hear it on TV, you don't hear it in the popular press about the liquidity being drawn out of the system. And I just want to show you how powerful this is and why thinking about markets for the next 2, 3, 4 years, how big a deal this is. If you take the chart on the upper left, we've all talked about quantitative easing, this incredible movement of central banks infusing the system with extraordinary amounts of liquidity, unprecedented amounts of liquidity. If you could see that green line, it's starting to come off. And when you look at that green line, it's like not that big a deal. It's starting to come off, but it's coming off very slowly. But I want to bring up a couple of points about the size of this liquidity and what it means. First of all, global liquidity moved from pre-crisis to 14% of world financial market capitalization to 24% now. Global liquidity exploded higher from 15% of GDP to 35% of GDP today, meaning that liquidity had an incredible influence over the economies and an incredible influence over the financial markets. When you start to draw it down, and there's something that's really important, when you start to draw it down, there's a couple of things that are important. One, markets go down 5 times faster than they go up. I don't think people realize that, because when markets go up, people take profits, much more smooth transmission. When markets go down, people just want out. So when you draw down the liquidity, you have a much more violent reaction, similar to what we saw in December, than you have when markets go up, point 1. Point 2 is when people look at that green line and say, gosh, it's not coming off that much, you can't take it in isolation, because if you look at the chart to the right of that, the U.S. Treasury is issuing $1 trillion of debt, draining liquidity from the system. And I'll talk about then the third part, and I'll come back to that. The third part is the Federal Reserve raises interest rates, which makes all that Treasury debt very attractive. What does that mean? You're creating what is, when you take the chart on the bottom left, this is global liquidity trending down. But it's not just that the liquidity is trending down. It's that when the Federal Reserve raises interest rates, the Treasury issues a tremendous amount of debt, particularly short-end debt. It makes it extremely attractive. So meaning that I can buy a 3% 2-year note, or I can sit in cash and get a very attractive return. And then what you saw play out at the end of last year is people say, gosh, I don't need to own high-yield bonds. I don't need to own equities. I can just sit in the front end of the yield curve. I can just sit in cash and create 3%. So you're getting what happens to be what I think one of the greatest financial transmissions we've ever seen very quickly. It's not just the reverse of quantitative easing. It's in the context of what the Treasury is doing and the central bank is raising interest. It's really big deal. I'll talk about the meaning of this going forward. By the way, part of why we've been pretty adamant the Fed has to stop raising interest rates, because you're doing this and you're making the front end very, very attractive, and you're forcing people out of every other asset class. It's such a big deal that played out, and I would argue hit its apex sometime in December. Really, really big deal. By the way, see it in our flows. You see it in the broader capital markets. This amazing sucking sound of money out of every asset into short-term funds. Really big deal. Second point, if you go to, and this is where Joachim did a great job on talking about the economy, which I won't spend too much time on. We have a similar view on the next page about the central bank, particularly the Fed, is raising interest rates, draining liquidity, at the same time that the global economy is slowing. Not only is the global economy slowing, but the U.S. economy is slowing. So the one point I would make away from the dynamic around the economies globally slowing is if you take the chart on the upper right, this is the growth index, and then we take the second derivative of growth, because markets tend to react to the rate of change when they do the absolute level. And you see the dynamic, I don't know if you can see this green line, but that's the Eurozone. And the dynamic around the Eurozone is slowing much faster than I think people would have expected. And then the chart on the bottom right, if you take, again, the second derivative of growth, the rate of change, China is slowing and inflation is falling off much faster. So one point I would make, in addition to how Joachim described, is we think global economy is slowing. But I just want to make one other point about this, is the left tail risk, meaning I think those lines are going to stabilize. I think Europe is going to start to flatten out at low levels of growth. And I think China is putting a tremendous amount of stimulus in and will start to flatten out. But one thing you have to think about in the investment paradigm is maybe we're wrong. And maybe the growth continues to decelerate. I don't think that's the case. But I will describe it as left tail risk or shock risk. If the economy slows faster, is something you have to build into the equation around the investment paradigm. By the way, the last point I would make on this is U.S. growth, on the same thing on this page, and I've argued this in meetings at the Fed and otherwise, is the U.S. economy is incredibly complex today. And it's not just the traditional manufacturing economy, it's much goods-oriented. And if you say, what is the neutral rate for interest rates? You know, I argued at the Fed meeting, I think we're there today when people say it's 75 or 100 basis points higher, because the interest-sensitive parts of the U.S. economy, housing, parts of the auto finance market, are really starting to come off. Meaning, I think the Fed rightly is pausing, as Joachim said. I don't think they're going to cut rates either, as Joachim said, but I think we're going to be in a low interest rate dynamic, and I don't think they're going to do very much at all. I'll talk about why for asset allocation that's such a big deal going forward. I think we're pretty static for a period of time. Next thing I want to talk about. So I want to talk about inflation, and as y'all are medium to long-term investors, there's something really profound about inflation that is not like the 80s, not like the 90s, and traditional economic models I don't think work today. If you take this chart on the upper left, and I know it's hard if people don't have the graphs in front of you, what that shows the volatility of inflation. If you go back to the 80s and 90s and think about what drove inflation, first of all, you had a population boom. Secondly, as women enter the workforce, you had this extraordinary influences on inflation. Last decade or 2 decades ago, you had energy prices that were moving all over the place. The point, I don't know if you can even see the end of this chart on the upper left, the volatility of inflation is incredibly low. Like Joachim said, flat as a pancake. I'll talk about why I think that's the case generally going forward. In fact, if you take population growth, if you take demographics and map it to inflation, this is a chart I did in the top middle, it's incredibly strong. Meaning, we're now in a period where the economy globally, where demographics are slowing, populations are aging, it means potential growth is slower, it means inflation stays lower for a longer period of time. It's a really big deal. The two things that I think influence inflation more than anything else, by far more than anything else, are demographics, aging population, people draw from the economy that contribute to it. The last point is technology. Joachim alluded to this. I think we're going through the greatest technology innovation evolution of all time on cost. The technology today is guided towards doing what we used to do at a fraction of the cost. So just a couple of charts I put on this. The one on the bottom left is a dynamic around the cost of data storage and cost of data transmission. Being close to Silicon Valley, there's an even more robust discussion. The cost of data storage and cost of data transmission has dropped exponentially. It means you can do everything on your phone, meaning you bring down the cost of virtually everything in the system. The other chart to the right side is when you technology adjust the amount of money companies are putting into technology to be the cheapest producer, distributor of product, seller of product in the world, has incredible deflationary headwinds. Not that we're going into deflation, but the risk of inflation spiraling higher is so low because of this technology and demographic influence. Really, really big deal. I'll talk about it for asset allocation. The one risk we're willing to underwrite is that inflation moves dramatically higher. By the way, I think it's going to move moderately higher, which we'll talk about, but we don't think inflation, and it's so big when you talk about you investing in equity, real estate, fixed income, can you write off that inflation is going to hurt you? And I think for the most part, that is an assumption you can make. If you go to the next page, maybe one last thing on inflation, and then I'll get into asset allocation, but I'll talk about why this is such a powerful dynamic today. If you take the chart on the upper left, when people say, get ready, the inflation is coming. I just don't buy it. When you break down the components of inflation, whether it's food, if you go back to the 70s and 80s, and you look at food as a percentage of CPI, it's only contributing 0.2%. Shelter and rent is significantly lower. Transportation and autos, it's hard to determine where it's coming from. Anyway, point being, I don't think it's picking up significantly. And you see the markets on the upper right. This is a TIPS market. It's building in obviously significantly lower expectations for inflation. I want to throw out one other point, which I also think is tremendously important, which Joachim alluded to. Every time I present at a conference or at a client, they say, well, wages are accelerating, so inflation's about to follow. We did a blog where I said higher wages leads to lower inflation, not higher. If you look at the chart on the bottom left, this takes a dynamic of wages, and you can see core CPI going the other way. By the way, I don't mean that at an extreme. We'll talk about how wages can lead to some inflation. If you look at the chart on the bottom middle, we're in a really different demographic cycle, as we talked about then before. People are putting more money into savings. When you lift income, more and more of the money is going into savings because people are concerned about retirement. They're concerned about their cost of college education. So what's happening when you raise wages today, in a goods-oriented economy, people buy a new TV, they buy a new radio, they buy a new alarm clock, and you create this multiplier effect on inflation, get into manufacturing, chemicals, logistics. When you have an economy today where people are worried about the forward growth of debt, you actually reduce the spending, and you see where savings actually goes higher. And the last point is on the right side, and you're seeing this today, literally today, is I think, and part of why I made that aggressive statement about higher wages reduces inflation, is it gets into margins for a company. When wages accelerate, if you can't pass it through in terms of your top line revenue, because you can't get pricing power, what it does is it crushes your margins or it denigrates your margins. When it denigrates your margins, you have to pull back on CapEx, pull back on inventory, and the system recalibrates, meaning it pulls growth down, so it means you don't create that much inflation. Really big deal. Not to overstate it, but I think the assumption they have to make for the next 2 to 3 years, do I get hurt by inflation deteriorating the value of my assets? Really big deal. Okay, so let's get to asset allocation. If you go to the next page, a couple of points that I would make on asset allocation, and I'll summarize where we think today, and I completely agree as Joachim said. The rate of growth is going to be slower. The left tail risk is higher. I don't think we're going into recession this year. I would even argue we're not going to go into one next year because you're approaching a 3% unemployment rate where consumption is 70% of the economy. In the U.S. particularly, I would argue other parts of the world could draw the U.S. into recession for sure. But if you assume that the uncertainty of growth is higher, if you assume that we're at the tail end of a business cycle, you have to think about volatility of your assets and think about what are the assets that are going to perform and what's the volatility of those assets. And these charts I thought were really interesting. If you take the chart on the left side, this is cross-asset volatility. And what it shows is in 2017, volatility was extraordinarily low across everything, debt, equity, commodities. That was la-la land. That was an environment that is not reasonable and is not going to continue. But if you look at what happened in 2018, volatility picked up. But look at the charts on the right side. Look at fixed income volatility. It doesn't really move that much higher. But look at equity volatility and how it explodes higher. It explodes higher. In December it exploded, but it's higher. I think this is such a key point for asset allocation. Volatility goes down the capital stack. I call it the fan of dispersion of returns, that if you're at the top part, the safest part of the capital stack, you shouldn't have that much volatility. The further down you move is where the volatility should go. And I'll talk a little bit about this in a second. And if you take, let's talk about what this means. If you go to the next page, the other thing that I think is hugely important, why was last year such a tricky dynamic for investments? And if you look at the chart on the right side, I don't know if y'all can see this, but Goldman Sachs did this. This showed that for the first time, other than recessions, all the way at the bottom, cash outperformed the 60-40 mix of equity debt. That only happens in recession. Cash outperformed risk assets, some combination of risk assets and the risk-free rate. The reason why I think that is so meaningful and what the Fed just did is so powerful is we lived in 2018 where an environment where the Fed was raising interest rates at the same time that you were having a slowdown in growth, and so risk assets and the risk-free rate were hurting you simultaneously. The reason why this is such a big deal today, if you take this chart on the top part of this page, is the correlation between debt and equity broke down, meaning you couldn't build a balanced portfolio. The 60-40 equity debt mix didn't work because your risky rate and your risk-free rate were working together. It's different today because you have a Fed that is symmetric, and the Fed is not just going to keep raising interest rates. So let's talk about what that means for asset allocation. If you go to the next page, first thing I would argue, if you think about investing for the next 5 years, 10 years, 20 years, what I put in this table, and there's a lot of data on this table, but I'm just going to draw you to a couple of key points. For the last 3 years, I just took high yield as a proxy for income, and then I used the S&P 500 as a proxy for beta. For the last 3 years, the last few months, it was get as much price return in the portfolio as possible. Equities dramatically outperformed the debt market, but if you go back 10 years or the last 10 years and 20 years, income did really well. Meaning your income did almost as well as equity in an environment where you had, what I would argue, a bit more stability. I mean, if you look at the chart on the upper right, what has been happening in the last few years is people have been going more and more into equity because I need price return. I need to get price, particularly when interest rates are zero. I've got to get price into my portfolio. That's the only way I'm getting return. So if everybody went into the equity market, what I show you on the bottom right is that all of a sudden income-producing assets have some carry again. Meaning you could buy per what I talked about earlier, you could buy the 2-year Treasury. The Fed would have to raise rates 11.5 times for you to lose money in a year. Meaning I can get paid for owning income again. It's really important in an uncertain world. I can now buy income and create a more stable portfolio. And if you go to the next page, just to play this out a bit more, and this is also compressing about 14 charts onto one page. The dynamic I put on the upper left, just to describe it, is this is returns. This is the size of different markets and the yield available in those markets. If you look at the bottom right, that's if you're sitting in Japan, you've got a 0 yield and about a 10-year duration. That is a hard dynamic to buy assets in. In Europe, it's about a 0 yield and about an 8-year duration. But if you look at the upper left, there's actually yield now in things like high yield, emerging markets, securitized assets. And I'll talk about it. There's one thing that's really, really important. People have talked about the credit markets are going to, you hear this all the time now. The credit markets are going to blow up the financial system. We're at the end of a cycle. We're going to go into a recession and credit's going to do it. This is a long, long discussion. Maybe in Q&A we get into it because I think it's the most interesting discussion today. Anyway, I don't believe it's true at all. The credit markets have not grown precipitously in terms of when you take some of the aggregate measures, the leverage is higher. But individual companies on the top right are trading at 2 to 3 times leverage, 2 to 3 times leverage. It's not that scary. But I want to show you one chart on the bottom, which is my best proxy that I've ever used for figuring out what you want to invest in, debt versus equity. And if you go back to 2011, 12, 13, I take the value of the S&P 500, and I take the value of the cash flow discounted by the cost to finance it. 2011, 12, 13, 14 were the greatest arbitrage in history. Fed moves interest rates to 0. Cost of financing goes to functionally 0. All the benefit gets to the equity. The equity market has to go higher, or companies buy back all their stock to get it higher. Today, if you look at this chart on the right side, your cost of financing has gone up because the risk-free rate has gone up because the Fed's moved rates higher, and spreads have moved out, the risky rate. It means income actually works again. So to summarize that, by the way, it doesn't mean equities go down. I just think they're going to throw off a reasonable return. Let's say that's mid to high single digits. But there's actually parts of the income market you can also throw that off too. So meaning you can build balance, you can build a real portfolio again, although you can be an investor again, that you can actually now use different parts of the market. And so, I'll summarize. I have 2 more minutes, 3 more minutes, 5 more minutes? Something like that. I'll summarize the last couple of pages, 5, I rock and roll. If you go to the page 10, and I thought this was really interesting. I'm trying to think through, y'all have, paradigm you have to talk about, how do I hit I used a 7.5% return target. And if you go back, if you look at the chart on the upper left, if you were investing in the mid-90s, I could have bought all bonds, 100% bonds. Can you see that on the upper left? I could buy 100% bonds and hit my return target. And then if you look at the volatility, if you look at the chart on the right side, my volatility is really low because I'm functionally defeasing my assets and my liabilities with my assets. I can just buy bonds. Now you go to 2016, 17, the only way I'm hitting a 7.5% return target, I've got to buy small cap equity, venture, private equity, et cetera. I've got to introduce more beta in the portfolio. Really big deal. It worked. It is the right thing. I think something is really, and when y'all think about investment horizon and paradigm, what I put on the bottom, if you had a 25-year time horizon, in theory, you would buy only equity or some equity derivative. But if you go look at what we did is you look at the left side of this, if you had a 1 to 2 year time frame and the horizon that Joachim described, that I would describe moderate growth, end of the business cycle, tail end of the business cycle, you'd put more income into the portfolio. More stability, more income into the portfolio, less equity for a shorter time horizon. I would argue there's probably some form of balance. And just to describe this on the next page, and why I think investing today, coming into 19, is so much different than coming into 18, is if you take these charts, and what I did is I show on the upper right, if you were building a portfolio in fixed income coming into this year, the only way you could hit a 7.5% return, and we'll talk about hitting a 5 or 6% return, but if you were to hit a 7.5% return target, you'd have to put about 60% leverage on it. You'd have to buy EM, high yield, secured assets, loans, commercial mortgages, but you'd have to put a good amount of leverage on it. If you look at the chart on the left side today, you could build a portfolio with no leverage in fixed income today. Again, it's not I wouldn't say it's a risk-free portfolio. It's got emerging markets, high yield, et cetera. The only point being is income has now lifted to a place today where you can actually build a portfolio that's more reasonable and marry it to your equity. I think it's such a big deal. Meaning if you can build, and by the way, it doesn't have to be a 7.5% return. Let's say I want to get 5% out of my fixed income. You can actually build 50% of it in treasuries today, and then 50% in risky assets, hit 5%, maybe I'll get 5 to 10 in my in equities, maybe private equity, I'll get my low 10s, meaning fixed income actually works again. It's a really big deal versus coming into 2018 where I just want to own cash. And it was the only thing that made sense, that now you could build a balanced portfolio, you can own assets to complement an equity portfolio and build more balance in the portfolio. Anyway, the last thing I would say on this is on my last page, and I think this may have the most data on the page, but I'm trying to think about the environment we're living in going, and I thought there was some really interesting parallels here. And you know, history, I found that history doesn't repeat itself, but it often rhymes. And there's some things you could learn from history, and I thought this page was interesting. So if you take, remember 2012, there's a lot of stimulus coming in the system. And I go down the fixed income markets, if you take the aggregate index, it threw off about a 4% return. And the global aggregate index threw off also about a 4%, I believe, return. Emerging markets got you, depending on was local or hard currency, got you some pretty dramatic returns. But then you had the taper tantrum. You all remember that in 2013, you had the taper tantrum. Fed starts to pull back on the stimulus. You had negative returns in 13. The reason why I think this is so interesting, if you look at 2017, it looked just like 2012. In fact, the numbers almost match, I mean, in an eerie way. Stimulus, you know, decent amount of stimulus still in the system. 17 looks like 12. Then if you look at November through November of 18, it looks just like 13. Not there was a taper tantrum, but the Fed pulling out the stimulus, negative returns in fixed income, the aggregate, the global ag, emerging markets come under pressure. If you carry this trend further, 2014 is a year where fixed income gave you a pretty good return. It was up 6% in the ag. The long end of the treasury curve was up 25%, the long end of the index. There's no way we're getting 25% long treasuries in 2019. The only thing I would say is that now you have a dynamic where you can make money again and you can build a portfolio. I can own some debt, I can own some of the treasury market, and I could marry it to equities, create some ballast in the portfolio, create some stability, and actually generate real return. It is coming about being an investor again, that you can actually build portfolios. Again, the key being real rates have moved higher. You know, now you've got, when people say, you know, where's the 10-year treasury going to go? And every time you're on TV or so where's the 10-year going to go? Like that's the only answer to fixed income. You know, the 10-year can move a bit higher from where we are today, but real rates are not bad. I mean, you're talking about 1%-ish. Real rates with a demographic of an aging population shouldn't be 2% anymore. we can debate, is it 1.25, is it 1.5? And if you believe inflation is not moving significantly higher, let's say it's a 2, the 10-year at 3%-ish is not bad. I'm not saying it can't go to 3.25, but meaning fixed income is actually now a well-priced asset again, and it works in a portfolio. Whether you're, part of what I described as being a lender today, there's actually real value in being a lender, being higher on the capital stack and getting some income in terms of being a lender. So anyway, a bunch of different, I'm sure I hit my number.
You're bang on, actually.
All
Right
right.
on 25, so
Thank
thank you. Just to try and draw things together and put some CalPERS perspective on it, John.
Thank you, Lauren, and thank you to the other two speakers. I don't have a presentation, so you don't have to, you're not slave to the PowerPoint for the next 5 minutes or so. But I wanted to bring together some of the topics that Joachim and Rick brought together and think about it in terms of the relatively challenging investment environment we face in the next 5 to 10 years relative to, say, the last 5 to 10 years where we had the Great Recession, and then we had a lot of stimulus coming in from both the government side and the monetary side to support asset prices. So we've been through that period. We're coming out of it now. So what are the specific concerns that make the investment environment challenging? Again, assimilating the ideas that have been spoken here already. One is mature business cycles in many developed economies right now. Second is the withdrawal of monetary stimulus of the past decade, so moving from so-called quantitative easing to quantitative tightening. And the third one, which Rick alluded to and actually Joachim did too, was demographics and dependency ratios, how they're starting to impact the global economy and potential growth in the next few years. So it's already been mentioned that the US expansion by June will have reached 10 years. There's nothing magical about 10 years, but the expansion is getting long in the tooth. We seem to be running out of supplies of labor and other things that could prolong the expansion. It's also not well known that this month represents the 74th month of the Japanese expansion. So Prime Minister Abe came to power in the end of 2012, and the Japanese economy has been growing for 74 months. For any economic historians out there, the old post-World War II record was the Izanami expansion of 73 months from 2002 to 2007. So we're entering new territory for the growth of the Japanese expansion. Now I have to say that expansion is becoming a little tired too. They've managed to expand the economy despite adverse demographics by growing very sharply the participation in the labour force of elderly people, females, and also temporary workers from abroad. Now it's starting to look a bit shaky. We've already raised that participation rate, and we've had significant build ahead of the Olympics, and we've had a couple of other factors supporting the economy that have been one-offs that aren't going to continue to support it. By the way, the Japanese economy in 2 out of the last 3 quarters has declined. So we're getting to a point where Japan has a so-called positive output gap. GDP is starting to fluctuate rather than just go up, and we seem to be reaching some constraints on the Japanese economy as well. Now, according to Chinese data, which came out on Monday, their economy is still growing at 6.4%. That sounds a good number. The 6-year average prior to that was 7.2%. But a number of the managers we deal with have their proprietary indicators of the Chinese economy, which suggest China's only growing maybe 1%, 2%, or 3%, not the 6% that they're announcing. So China really goes into an actual recession, but it does look as though the economy there has run out of steam. They have a lot of levers to pull, but it's not always successful, and it takes some time to arrest a decline in the economy. And with the geopolitical adversarial relationship with the US, it becomes a little bit more difficult to do that. Finally, Europe, we're used to problems in the so-called PIGS countries, Greece, Portugal, Spain, Ireland, etc. The weakest economies right now in Europe are Germany, France, and Italy. Now, there are some idiosyncratic reasons for that, the Yellow Vest protests in France, and emission standard changes in Europe, which have led to some temporary declines in the auto industry. But with Brexit coming up and no obvious catalyst for growth within the euro area, there is some risk that economic expansion is also out of the way. Now, Why that concerns me is we don't have much runway in terms of being able to start easing again if we need to. You know, the Fed in the last cycle started with rates well above 5%, same in Europe and maybe not Japan, but our runway in being able to support economies if these business cycles are turning over a bit is much more problematic. Then you look at demographics. And I want to mention demographics for a key reason, because Japan and China are the two main investors into the US over the last couple of decades. Japan's aging population is well known, and as I've said, they have been able to circumvent the decline of the population by increasing the participation by women, elderly folks, and temporary immigrants, but it's a key trend that isn't going to go away, and in fact Japan's population is starting to age very significantly, and they really don't want to allow permanent immigration, which would fuel a significant rise in the economy. In terms of China, it's little understood that China, according to Scott Grimberg, our EM analyst, made the comment today that there's a risk that China has failed to get rich before it gets old. China is trying to get out of the middle income trap right now, but the American Enterprise Institute released a report today that said between 2015 and 2040, 500 million people in China will move to 50 plus, and the under 50 population will decline by 500 billion, quarter of a billion people. So a quarter of a billion people moving from prime working age into elderly. And that essentially affects your potential growth in the economy. Now, this is a double-edged sword for the US. You know, JGBs in Japan yield zero. If China slows down, these countries essentially will be seeking more return abroad, and maybe the US can provide that return. On the other hand, as people get older, they tend to save less, so the savings pool available for investment abroad becomes less. So demographics is a challenge that we think about all the time in terms of what markets are going to be giving you over the next 5 to 10 years, particularly when in the late 2020s, these issues in Japan and China become more pervasive. Then I want to finish with the US, and again, it's become a little bit of a cottage industry. Every sell-side analyst and manager that we deal with has a business cycle indicator for the US. Why is that so important? Because equities and bonds behave differently at different stages of the business cycle. And before the Trump administration got in the end of 2016, the consensus was that the expansion would last until about the middle of 2019, which is about where we're coming to now. Then after the two fiscal stimulus that the US had, the Tax Cuts and Job Act of 2017 and then the bilateral budget agreement of 2018, a lot of analysts said, well, the expansion is going to continue for longer. And there's a lot of debate about that. If you're suddenly throwing a lot of money at the economy in late cycle, it's a demand shock or a sugar high, as some people say. So why doesn't it bring you to the end quicker? Well, the argument is, from the supply side, is that it's not just a tax stimulus, it's a tax reform. So when we think on an ongoing basis within CalPERS about how long the business expansion could last for, and therefore the likely relative performance of equities and bonds, we think about three things. One is the US labour force. How quickly can the US labour force continue to grow? It actually grew quite quickly in 2018. It was a good year for labour force expansion. But it was all females, and it was all in the Latino area. The cohort of young men continues to be underemployed in the labour market and is just not coming back to the labour market 10 years into the expansion. This is caught up with a lot of social policy like opioids and other factors, and it remains an open question about whether we can continue to fuel the expansion by having people coming in. Second factor is productivity. While there hasn't been a pickup in CapEx as a result of the tax cuts, a lot of those tax cuts have just gone to buybacks and dividends. There has been a CapEx improvement in the last 5 years, and if you think about a 5-year lag between CapEx and productivity, there is some hope that productivity in the next few years will help. Why is that important? Because it means with a given supply of labour, you can continue the expansion for longer. And the third thing, which I think both speakers have alluded to, and I have maybe a slightly different view on, is the Fed. One model that I look at is the Fed tightening cycle in the 1990s. So the Greenspan Fed started to tighten monetary policy in 1994 and finished in the year 2000. That expansion went on for 10 years. It was a relatively low leverage or borrowing expansion and a low inflation expansion at various different points of that cycle. The Greenspan Fed on 2 occasions within that 10-year cycle was able to cut rates. It cut rates in the second half of 95 and during 1998. First time it saw that when it raised rates quickly, the economy reacted a bit, so it cut rates back. And then in 1998, as markets fell after the Asian crisis, etc., it was able to cut rates again. So I would not be too concerned about markets starting to price in Fed cuts that it means necessarily a recession. It essentially means that the Fed can react act proactively to offset the risk of a recession. And as Joachim mentioned, the country of Australia has had a 27-year cycle. During that cycle, it's actually had 4 episodes where it's been cutting rates and it's headed off the likelihood of a recession. So the ability of the Fed over the last few weeks to agree, and there was a speech with Powell, Bernanke and Yellen all together, essentially saying, look, you have to be flexible and cognizant of trying to prolong this economic cycle. You have to be flexible and say that there are going to be periods where we back off on rates. We could maybe even cut rates if 2 things happen. One is leverage in the economy remains benign, and so does inflation. And I agree with the other 2 speakers that inflation in the economy this year is actually going to be quite low. So these factors are ongoing things that we look at. I personally think we do have a fighting chance for the economy to make the 2.3% that the Fed expects for this year. 2.2% that is the consensus growth number. It's down from this year, but there are a number of factors that would be causing that for the case. So that wouldn't be too bad for markets. What I do worry about is that 5 to 10 year time frame, partly because of the demographics I've mentioned, partly because of global business cycles being very advanced, and also by the end of this year, the fiscal free lunch that we've had in the US by stimulating the economy for a couple of years goes away, and in fact we hit a mini so-called fiscal cliff in the year 2020. So bottom line is, I'm fairly optimistic about this year using the same kind of tools as these guys, but I worry about 2020 and beyond for the various factors that I've mentioned. So that's, I'll stop there.
Thank you, John. So this is a lot to sort of chew on, as it were, and some of my takeaways here is, Joachim presented an excellent overview of where he sees the US and global economies and where he sees them potentially going over the next 6 to 12 months. Rick sort of dove into the details a bit more about what does that mean, what are the implications for asset allocation going forward, and how can we sort of reach, we being CalPERS and asset managers overall, reach the returns that they are required to make. And then John pulled it all together and presented some of the risks going forward, and also sort of laid out that we need to remember that some of these secular trends, demographics, productivity, we need to be cognizant of them, and they can act as drags or anchors, or in fact help to boost the economy over the more medium term. So I'd like to open up for questions, if there are any. I have many notes, so, but please, does anyone have questions?
Ms. Ma.
Hello? I have a question for the first speaker. When you talked about the, the politics and populism trend, that you're worried about the wealth inequity, and if, I guess, governments are going to directly try to address it through some policy, and I didn't understand that comment. Like giving people money instead of trying to encourage housing? Is that kind of what you're saying?
Yeah, good question, and thank you for giving me an opportunity to clarify. So So what I have in mind is that, I mean, in many countries, within many countries, we've seen this rise in income and wealth inequality over the last 20 years, right? And I think, this has become a major issue. So I think this is one of the reasons why President Trump was elected, because, you have parts of the labor force that are not participating anymore, and John mentioned that, and there's a lot of frustration out there. And you're seeing the same in Europe. So if you look at France, the yellow vests, that's also a protest against these situations. You could argue Brexit in the UK is also a response, it's a protest against the existing system. So I think it's quite natural that politicians will try to respond to that. And we may see more radical forms of trying to redistribute wealth and income. And one way to do that is through higher taxes, higher income taxes. There's now a proposal here in the US on having a 70% marginal tax rates on the part of incomes that exceeds a very high threshold. Wealth redistribution through higher property taxes or inheritance taxes is another thing that is discussed in many countries. So I think that's one way how the political system will try to address that. And the risk with that is that, as always, that politicians overdo it, right? You could argue that we overdid it on one end. We overdid the deregulation and the move to, fairly free markets over the past 30 years. And the risk is that we're also overdoing it on the other side. So we get so much redistributive policies that it actually dampens growth and investment with negative longer-term outcomes. So that's what I had. Does that answer your question?
Yes,
Yeah.
yes, it does. Thank you.
Ms. Taylor?
Yes, thank you. Okay, there we go. Thank you. I also wanted to kind of piggyback on Ms. Ma's commentary. So we've been worried about populism from the other way all over the world for the last few years because of the Brexit and the election of Donald Trump and what's going on in Italy and what happened in Brazil. So we're not even, I don't think there's a fear yet for where monetary policy will go if we finally address the wealth inequality that poses a fundamental risk to everyone's portfolio when you really think about it, because having that's what's caused all of this political unrest to begin with. So I understand what you're saying in terms of governments tend to overdo, and let's hope we're smarter than that if we do try to enact policy that sort of corrects this extreme wealth inequality that we are currently under. But as you can see by the federal workers who are supposed to be middle-class workers are living, one paycheck from the street and having to seek help. That's the result of the last 30 years that you're talking about. So I think my question to you is, if it were done in a constructive manner where we're redistributing wealth to mitigate some of this policy that can cause long-term risk to our funds, do we see that as helpful rather than harmful?
Yes, thank you. So let me just make clear, I was not trying to make a value judgment. I was not saying that, rising inequality was a good thing in my view, and, fighting inequality is a bad thing per se. So I think there are many good reasons why it does make sense. And actually, me having a European background, I think there are quite a few examples of relatively successful economies in Europe. If you think of the northern European economies, Scandinavia, also Germany, at least more recently, that have much lower levels of inequality and have been doing quite well. So my point was that markets, 2 points. One point was that whether we like it or not, markets are unlikely to like it, or equity investors are unlikely to like it, because part of the policy will be to redistribute from capital to labor. So the pendulum swinging in the other direction. So I think as investors, we have to try to take that into account, even if we think that, for social and economic, longer-term economic reasons, may actually be a good thing to do. And the second thing, which you have picked up on, is I think there's also a risk of overdoing it. I'm not saying we are already overdoing it. We're probably underdoing it, but there is a risk of overdoing it.
And then I think I had one more question sort of drawing on that. I was a little confused at the graph on page, and I think that's yours.
Okay.
And I can't read your name from this far away. I apologize.
It's Rick.
Rick?
Yeah.
It looked like it, but I wasn't sure.
All right.
So that first graph you were talking about on page 2,
Okay.
where the green line,
Yeah. Yeah. Yeah.
I'm really,
Liquidity.
so, and then the next over, the
Yeah.
two next over.
The Treasury. Yeah.
I think I was a little confused. Are we still doing QE? Is that what?
Yeah. No. So by the way, can I hit, because I thought your question. Yeah.
Sure.
Was that the?
Yeah,
so,
yeah.
By the way, I would say, and I want to wrap it into one answer, hitting both of those points. I think there's something when you think about where we are point in time, and part of why we've been pretty adamant about. I think interest rates were kept at zero or too low for a very long time. Now you're actually at a place where you're getting close to equilibrium. You're getting to where I would argue today, when you hit the interest-sensitive parts of the economy, that hurts consumers. When you start lifting mortgage rates to levels that are clearly impacting housing, I think it's a really big deal. But there's something also that I think is hugely important. Your point that I think is very well taken. What's happened in the last year or so, you're putting more and more people to work. The unemployment rate, we think, is going to trend in the low 3s. And you're actually seeing more income getting to quote-unquote labor, and you're actually seeing closing the gap now, where you're seeing wages increase and you're seeing small to middle income. What we've improved, one of the things we've argued aggressively is there's an asymmetric dynamic today. If you believe that inflation is not going to accelerate that much higher, which I think is the case, and I think the Fed has a multitude of tools to deal with inflation. You can sell assets, you can raise interest rates, you can lift interest on excess reserves. We should put more and more people to work in this country. And there's this fear, if we get to 3%, it's going to create higher wage growth, which creates inflation, and the Fed has to abrogate that. I just think it's flat wrong. I think we should keep putting more and more people to work. The debt's growing, and I'll talk about the second part of your question.
Sure.
The debt's growing. The cost burdens that people have are growing. Why in the world do we want to cut off? If we're not that worried about wages getting into inflation, which I think is right, put more and more people, continue to by the way, I'm not saying just don't move to a tightening, a restrictive policy. We should embrace the fact that more people are working. And you hear more and more people say, my God, until employment slows down, the Fed is up. Like, why do we want employment to slow down? I think
It's always been an interesting issue that I've always noticed. If employment slows down, the stock market goes up.
Yeah, but anyway, I think we're in a different environment than we were when rates are at zero. That, putting people to work actually think is very healthy for the economy, very healthy, quite frankly, for the dynamics that you were alluding to. Second point I would make that is tremendously important, and I don't think I did a great job of describing it. We just went through, you had a dynamic where you had an easy monetary policy for a long time, and then all of a sudden we put fiscal on top of it. You've never seen that before, where all of a sudden you got easy and now you got easier fiscal policy. But the downside of that, or the backside of that for the next 2, 3, 5, 10 years, is we're going to issue a lot of debt to fund it. Okay. And the point I was trying to make about those bars, which probably didn't do a great job of, to fund the fiscal stimulus, we're going to have to issue a net $1 trillion of debt. And what ends up happening is that it creates a crowding out effect. It creates a significant, particularly if you raise interest rates, you make that treasury debt, which is the risk-free rate, you make that extremely attractive, and it takes investment from everywhere else.
Okay, I misunderstood what that was. Okay.
But we have to fund, there's a huge amount of debt that's coming to the market from the treasury. We can debate if it's risk-free, but it's pretty darn close to risk-free. And if it's at an attractive level, gosh, do I have to invest in real estate? Do I have to invest in...
If you're going to get the same amount back. Yeah.
Right. The only point being, I think we're close to neutral. There's a balance that's really hard to strike. And when you drain the liquidity by reducing the balance sheet and then you issue a lot of debt at attractive prices, you're draining investment from a multitude of places. And that now we're at a place today where we're closer to equilibrium, that you don't have to keep pushing rates higher to absorb it.
Okay.
And by the way, you push rates higher to absorb it, the cost to the country is going to be significant the higher rates are that we have to fund that Treasury issuance.
Right, right.
Anyway.
Thank you.
Yes, thank you.
I just want to draw out from that something that some of the thematics that I received here, and Joachim sort of mentioned that the Fed looks like it's pausing. Quantitative easing has ended, but the balance sheet, as it were, the size of the Fed's balance sheet is still quite large. Rick's pointed out that the US Treasury is likely to be issuing more debt and said there are opportunities and cash is paying at the moment, but of course, if the US Treasury issues trillions of debt, then interest rates may well rise further. So there is a risk and an opportunity here that I think is difficult for investment managers going forward.
I agree.
Do we have time for one more question?
We've got time for a couple more. I have two, but I'll do this one first. You mentioned about technology being used to reduce costs, and the whole technology, including AI, is going to make production more efficient and savings, et cetera. The long-term implications of that, though, is that replaces people, the consumer. And so you need consumption to grow an economy. So where is this nexus going to occur?
So I'd say a couple of things. First of all, it's very hard to look 5-10 years out, but your points, no doubt artificial intelligence will replace, similar to other technology, will do what we used to do at a fraction of the cost. It's part of why I believe in my underlying thesis, keep putting people to work. And today, I think there's a structural dynamic in the economy that's really different than anything you've ever seen before. Is it particularly U.S. economy, to some extent Europe and other places, has become a service-oriented economy. You look at the amount of hiring, including this past month, in places like healthcare, places like education, they tend to be very labor-intensive versus manufacturing and artificial intelligence that takes a lot of manufacturing jobs away. The growth of the service economy tends to be much more labor-intensive. And why I'm a huge believer in education, and been a long discussion about urban education and other dynamics, is I think education and training people for what is the next set of decades in a more service-oriented economy, and an economy that will see a lot of jobs that potentially get replaced. I think there's a couple of ways to address it as a country. One is put as many people to work today and create as many jobs as possible, grow, as you said, keep the consumption growing. 70% of the economy is consumption. I think that is healthy. And then the second is education and training for what is a new set of dynamics in what is a more service-oriented economy. The other side, as John said, of the demographic of aging is going to be more in healthcare going forward. Is going to be more, I would argue, in education and other fields. Those are labor-intensive jobs. People talk a lot about productivity. A lot of the jobs, or not a lot of them, over 100% of the jobs that were created in the last 5 years, 6 years have been in the service sectors. And training young people in some regard to be in those fields is hugely important because of, like you say, it's hard to predict the oncoming artificial intelligence or replacement of roles.
Ms. Hollinger?
Rick, my question was for you. I view if we have a recession today, that there are less levers to pull because we've lowered interest rates, the quantitative easing, and I question whether, I think your conclusion or your analogy was it might not be as severe but more prolonged. Yeah. I think the impact of not having any levers to pull.
So I might pivot off something Joachim said that
Okay.
That was spot
I'm sorry.
on.
I apologize.
No, that's okay. I'll pivot off. No, I'm sorry. So Joachim said something I thought was pretty profound. If you're sitting in Europe today, you've got interest rates actually below zero.
Right.
And you have a really tough dynamic. There's a long discussion about the capital key and your ability to buy more assets and do quantitative easing. I think Europe is in a brutally hard position.
Right.
But I may disagree a little bit in the U.S. in that you've now got real rates higher. We've moved real rates back 200 basis points in a demographic that I think can support that's going to cause it not to go much higher. Anyway, I think you have interest rates that is a real tool you can utilize. The second, I think, so, you've done quantitative easing, but I think there's something, and to just put it in perspective, the Fed's balance sheet is 20.3% of GDP. It's 40 in Europe, and it's, 80% in 100 in...
Just reached 100 in Japan.
100 in Japan on its way, that's right, I think we projected out 104% at the end of this year. So it's 20 in the US on its way to, I think it's to 18. It means you could go again on quantitative easing. Europe at 40 with a hard time with the capital key and 19 countries making a decision. But I think there are more tools. I think the Fed has more tools. The tricky one, which I think is part of your question as well, we just spent a lot of the fiscal tool at a time when the economy was in pretty good shape. That makes it a little harder today given the size of the debt we're growing. But, I think in the U.S. you still have some room in the monetary policy side. And, by the way, you can do things with interest on excess reserves and velocity in the system. So I still think, your points are well taken. Rates are low historically. But I still think there's a lot of tools that you have left.
And what team about Europe?
So in the spirit of debate, because we agree on so many things, so let me just disagree with Rick on that. It's true that the U.S. has more tools. I would just argue that, at 250 base, at 2.5% Fed funds rate, we have less than half of the room to cut rates than we had in the last cycle when we started at 5.25. So the Fed can ease, but not as much as in the last one. And then on quantitative easing, yes, I agree with you, Rick. The Fed can do a lot more. They can expand their balance sheet a lot, but I would argue they will get a lot less bang for their buck than last time because rates are already so low and the so-called term premium in bond yields, which they're looking to depress, is already negative. So that's why that was the background why I thought that the next downturn could be shallower but longer. But I think you were trying to ask why shallower.
Yes, that was my question.
So that's simply, it's easy to say the next one will be shallower than the last one because the last one was the deepest in a century, right? And there was a big financial crisis. This time around, we don't have the kind of excesses in the real economy. We don't have the overspending that we had in the last cycle. So there's more of a cushion. Companies have not overinvested as they did in the late 1990s before the 2001 recession. So that's why I think there's less need for a major correction. But my worry is that, it may not be as deep, but it could just go on and on and on. So Larry Summers would not talk about secular stagnation as he has over the last few years, but secular recession.
Thank you.
Okay, Mr. Miller?
Yeah, great discussion. Thank you. I just wanted to build a little bit on something that Henry had kind of opened us up a little bit. And in terms of, we've seen there are all these variables and factors that impact both wage growth and productivity. And in the past, we've seen, wages stagnate while productivity was increasing for a long time. And now it seems that, we're having wage growth that maybe is driven more by demographics or capacity or something. And productivity doesn't seem to be as much of a driver. It may have, but with this shift more to a service economy, do you see productivity, the pace of productivity growth picking up and changing that dynamic, or just we still kind of maybe hit a plateau or a limit with productivity growth?
So I had a couple of things. So productivity to me is hard because you have such a complex economy today. So we track, traditional way you measure productivity is you look at your output relative to employment or resource. And it's actually pretty amazing. If you just take the manufacturing sector, productivity is actually growing precipitously because we have actually fewer people in manufacturing and output has been growing. So productivity is growing substantially. And if you just looked at a traditional economy like it used to be, much more manufacturing. But the economy, like you say, has moved so much more towards the service economy, and the service economy, we tracked it, people say productivity is coming off, but actually if you measure it right around health, because of this extraordinary hiring in healthcare, in education, in areas where it's very, very labor intensive. By the way, I think it's really healthy for the economy that you're putting more and more people to work in a dynamic that is so much more complex today around where the economy works, particularly in the US, different than in developing countries around the world. But I would argue that when you take straight manufacturing productivity, some of the advances we've seen, so that one chart that I showed about investment in technology, so people say, actually, if you look at CapEx on technology, it's actually not growing that much. But we don't pay the same amount for a computer today as we spent 10 years ago or 20 years ago, and the cost of data transmission and storage has fallen exponentially. But if you if you technology adjust it, the amount of money that companies are spending on particularly software, and are going to become efficient is just literally almost vertical line increasing. So what does that mean longer term? And I thought why the question was great around artificial intelligence, et cetera. We're going right down the fairway of increasing productivity in traditional businesses and traditional manufacturing. But I think it's really, really important that we get that in the service-oriented economy, that you just keep growing and training and you put more people to work. There is a structural dynamic. I think we're going an unemployment rate that I think can go to 3 and below 3. And I actually don't think there's enough people in the country today that are trained and can move into these sectors. And I think it's a pretty healthy part of why, I think the economy, the recession is not going to be that deep. Is I think you're going to keep putting more and more people. You're seeing people enter the workforce now, more and more people, and I think it's really healthy. And I think you'll see structurally that we'll keep more people employed for a longer period of time than we have ever before. But I think it's hard. People talk in aggregates. I think economists, you see these discussion about aggregates, and I think you have to break it down into the individual component parts, which are so complex today in the U.S. economy.
On this, just a quick one on the wages productivity link, because it's an important question. I think it's a little bit of a chicken and egg problem. So you could argue stronger productivity makes it possible for companies to pay higher wages. But you could also say, if wages are increasing faster, it creates an incentive for higher productivity. And actually, Janet Yellen, who I really admire, long before she joined the Fed in the 1990s, she was a pretty well-known labor market economist and academic. She and a couple of other economists invented this efficiency wage theory, which said that companies that pay higher wages, that pay their workers better, will get higher productivity in return. Because people feel better about their job, right? They are more eager to keep those jobs, they work harder. And I think there is something to it. So, and we are actually seeing wage growth is picking up and productivity growth is picking up at the same time. So that would be my response.
Yeah, I guess I need to take another round at the comments that Dana was making regarding the recession and possibly how long. Because I thought I heard John say that 2020 possibly is going to be in a recession. And I think that other economists are also talking about a recession coming. Growth is slowing. You talked about the tools in the toolbox of the Fed. John mentioned that when it happened before, it was at 5% interest rates, and now it's down to 2, so you lose some leverage there. You talked about the liquidities that's being drawn out of these companies, and when you do that, they have to create leverage. The debt, the federal government debt is higher than ever. So should we continue to be talking about unconventional investment strategies with all of these things on the horizon?
So I think it's a hard question. I'll throw out a couple things. There is I think it is I know from many meetings at these Fed advisory meetings and otherwise, there is a big discussion about how good your economic forecasts are out beyond a year. I think it's really hard. I think there's a series of exogenous influences on the economy. There are things that are, globally, I would argue we're not used to the size of China and their influence on global trade, et cetera. I think it's really hard. And to project where we're going, part of it I was arguing that the left tail risk is higher. The uncertainties are so much higher. The amount of debt that's being put on is higher. So I think it is difficult. Part of what I was trying to describe is, like you saw, my sense is we're not going to recession anytime soon, largely because of the consumption dynamic, the employment dynamic. But listen, there are things that could happen that could create a recession in 2020. The one point that I was trying to harp on around the presentation is if anybody tells you where we're going to be a year or two hence, I think they're not being fair. And part of why I argued building a balanced portfolio and using other tools and using, moving, if you can move up the capital stack where the vol goes down, and if you use up the capital stack, create more stability in the portfolio, create more ballast in the portfolio using risk-free rates and otherwise, is I think the right thing, because there is, where things are going to be 18 months hence, I think is really hard to predict. And now, for the first time in a while, you actually have an ability to buy other assets to create better balance in the portfolio. Where I'd argue in 2000, coming into this time last year, it was really tough to create, quite a while. I would argue it's hard for people with long-term time horizon to do this, but sitting in cash made a lot of sense last year. What you do going forward, I think you build some balance. And because anybody who tells you, I always find it very funny when people tell you the dot point, where the dot plot's going to be in 2021. I think the Federal Reserve would tell you they have limited idea. And I think in this environment particularly, I think it's hard to figure that out.
Oh, Ben? Yeah.
Yes, thank you. So this is a question for Mr. Reader. So you talk about building a balanced portfolio. And let's say that you can only build a portfolio with public assets, public equity and fixed income. And given two constraints that CalPERS is facing now, for one, our size. So I know you made a case for high yield for cash. Yeah. Cash has a lot of liquid depth to it, a very deep market, but cash doesn't yield enough to 7%. High yield offers probably a better potential, but the liquidity, the depth there is not big enough for CalPERS. So if you consider two constraints that we face now, our size, and then the other one is we cannot afford another meaningful drawdown in the system. How would you build a portfolio with public asset only, or how easy or how hard it is to build a portfolio with public asset only to achieve a 7% of return in the near term and the intermediate term?
Are we out of time for questions?
So we always save the best for the.
Yeah. So anyway,
it's a simple question. I know it's not an easy one.
This will be time for a break. So Ben, I think it's a very, very hard question, and so one man's opinion of that. Hopefully you get invited back again sometime in the future. I think 7's hard. I think 7's really hard in 2019. Similar to what I think everybody described. We're staring at slower growth. We're staring at end of the business cycle. We're staring at valuations that, quite frankly, are not as stretched as they were, but across the continuum, the valuations are not that attractive. So, if only using public investments, hopefully this isn't avoiding your question. But I think today in fixed income, I think you can, depending on how much risk, how much dispersion you'd want, I think you can create. We've shown you can build a fixed income portfolio, create a 5% using 50% the risk-free rate in the front end of the curve. If you can build 5 in fixed income or take a bit more risk, I'm not a huge fan of the high yield market today, but at 8-ish, there, you're getting, if defaults are going to go to 3, your carry's pretty powerful today. That, if I want to create, maybe I can get 5 in fixed income, maybe I'll take a little bit more risk, I can get closer to 6. Then I do think the public equity market is going to have a decent year. Could you get high single digits? I think that is possible. And by the way, I think the emerging. Can I use emerging markets? I think the emerging markets. I think Joachim described it as well. I mean, you have a dynamic where if the dollar's not appreciating significantly, which I don't think it will. I think the Fed's now on autopilot to some extent, or flexible, I should say, if the dollar's not going to appreciate significantly and rates are not going to move that much higher, the parts of the emerging markets, you're getting in the debt markets, you're seeing local rates, you're getting 7, 8, 9%, depending on where you want to go. Hard currency, you're getting decent yields now. If you layer in some emerging market investment, I'll take some public equity, and if I can create a 5-ish in fixed income, 6 if I take a bit more risk. That gets me closer. And, if I use a healthy component of treasuries, your point about, not wanting to draw down, treasuries will act, I think now with a flexible Fed, as a hedge, an organic hedge in the portfolio. And I showed this chart. I showed investment grade credit that if you take the risk-free rate and the risky rate, you know, your price volatility should be lower in investment grade credit today. We can debate the leverage thing, which I think is true, but not nearly as extreme as people say. Boy, you can create 5 to 6 in aggregate. You know, layer in some public, and maybe I'd cheat a little bit and say y'all can use some real estate and private investments and get that number closer to, but it's, you know, job's hard. My job is super hard.
Yeah. Mr. Phelps,
I-
thank you for saying that.
I agree, 7.5% is really hard. And
7.
Or 7%, it is really hard, and I'm pretty sure you will not be able to achieve it without, you know, a significant allocation to emerging markets, and you probably also need to lever up some of your investments. I know that's not very popular, but I think without leverage and EM, it won't be doable.
But with leverage and emerging markets, so emerging market, the depth is not really there. But we add on more risk and the leverage that really comes with the potential larger drawdown risk. That's one of the constraints that, you know, we have. We cannot take another larger drawdown.
Could I just draw into that? Joachim had a chart talking about financial conditions and how they've tightened somewhat. And one of my questions is, so yes, financial conditions have tightened and they've gone from very easy to somewhat towards average. So is this just a wobble? And thinking about the tactical, so the timing of investing, if it is possible to invest, is now the time to invest? Or if you're thinking about some further decline, you know, is that for consideration at some point in the future? I'm wondering what your thoughts are on that.
Is it now time to invest? Well, it's definitely better after. It's definitely better than it was, you know, before the fourth quarter of last year. I mean, we've seen in several asset classes, we've seen valuations becoming less rich, right? I wouldn't say cheap. I mean, some areas maybe things are a little cheap. And I think another important point is the Fed has shifted course. So the Fed has blinked. So yes, I think there is a possibility to, you know, put some money to work right now, better than say in the middle of last year. But overall, I think we are still pretty cautious, and we are resisting the temptation to go all in at this stage for the reasons that I explained. We think there are still a lot more rude awakenings to happen. So it's better now, but there will be even better opportunities, which is why we are not using our full risk budget in many of our strategies, and we like to have some dry powder that we can use if we get these rude awakenings.
I'll throw one other thing. I mean, I think this concept, you build balance in portfolio now. If there are some assets and the risk-free rate moving up and risky spreads, I think there's some assets make some sense and some assets that have overshot. And I think one of the benefits, I think it's really important to think about what is your liability stream and what is the tenor of your liability stream. A lot of what's come under pressure recently, we talk about liquidity being difficult. If you can use illiquidity and you have given a scale of a portfolio and running some balance around, I can be one of the lenders or one of the investors in less liquid markets. That is a huge benefit to investors like y'all. And if I have a long tenor and I could take, some of the things, whether it's in parts of the securitized market or parts of commercial real estate, parts of the credit markets, the loan markets, some things have overshot, and having the benefit of a long-term liability can be really helpful in some of those stress markets. So places like that, I think, can be very advantageous, given what happened the last few months.
So if I could maybe round that off and try and sort of summarize and finish up here. What I'm hearing is that our panelists are seeing, the US and the global economies are still doing okay, but not as well as what they were doing, and the future is looking far more uncertain. But with some valuations having pulled back, there could well be some opportunities. But looking forward, there are quite a number of risks, and risks in particular in terms of volatility and liquidity of asset prices going forward. So potentially dip our toes in, but a rough ride, maybe, if I was to put it in one sentence. But thank you to our panelists today. Greatly appreciate that.
Okay.
I think they've done a wonderful job.
Thank you. Just a minute. We have another question. Jason, Mr. Perez.
Jason, perfect, sir. Thank you. I'm the rookie on the board, and so everything you're talking about is really good, but I kind of need to dumb down a little bit, and I would appreciate an answer from everyone if possible. Do we need to change our scheme or our model for the private market? Are you saying, and we do or we do not need to do that right now? Sirs and ma'am. Does that make sense?
Is the question on your private investment side, do you need to change your model versus public investment? Is the question, should you invest more in private assets rather than public assets? Or?
If I may, can I just interject? That would be the discussion for the following panel. So this panel is on public market perspectives. And I asked the question, without using private assets, how easy or difficult for them to build a portfolio to achieve 7% of return. And I was doing that more like teeing up for the next panel discussion.
For funsies, can we have an answer?
Yes.
Pretty please?
Yeah. So, but if you would like to comment on, on that, you're more than welcome to.
So on private versus public.
Right. I just don't know how they're up to speed on the
Is that the question? I just want to make sure I'm answering the right.
Do we need to change the way we are approaching the private market? That's what I'm asking.
Well, I don't think I can answer the question because I don't know in detail how you approach the private market. We think private investment, private credit, and private equity should be a very important part of your portfolio. And we think that over the next several years, you will probably find some very good opportunities, particularly in private credit. At the moment, certain sectors of that market look fairly expensive. But if we get these rude awakenings that I mentioned, I think you will get some dislocations in markets that, will create great opportunities. The thing is, you have to be prepared for that. Now, I know that CalPERS is very active in that area in private equity. We are building our capacities in private credit, which we think will also offer some very good opportunities. I hope that answers your question.
So I'm not perfectly versed in all of it, but I would say generally not the what the only thing I would say is I do think we're entering a more uncertain time. I do think all we've talked about, growth is going to be lower, and I do think the most important thing I've learned in my 31 years is when you have a lot of growth and a lot of cash flow, things become a whole lot easier, and you can make a lot more mistakes. One thing I would think going forward is I think the hurdle rate, the more illiquid or the longer term the investment, I think the hurdle rate has to be higher. And I think if you can create a more liquid, risky or less risky asset, and hit a mid-single digit return, I think the hurdle rate on a longer term, less liquid, more uncertain investment, that hurdle rate has to expand. That is the only point. I don't think there's structurally anything different around the private market. I just think what people should command to use their dear liquidity and their dear capital, if it's going to have more risk or we call dispersion to it, I just think the hurdle rate has to be higher than it was 2 years ago, 3 years ago, 5 years ago.
I'd just simply be asking two questions. One is, was quantitative easing that happened over the last 10 years in the economy, did it raise the price of public assets more than private assets? And therefore, as we move back into a quantitative tightening, will the reverse be the case, or did the rising tide float all boats in terms of public versus private? And the other one is, if we are entering a late cycle phase of the economy, whether it be 2 or 3 years down the track, what is the different behaviour of public versus private assets? There's plenty of history that you can go by to assess the relative performance of public and private. I don't know about the model itself, but I think the move from quantitative easing to tightening and the fact that we're moving toward late cycle are factors in that relative decision between public and private.
Mr. Reeder, you, in response to Mr. Perez's question, you made reference to the hurdle rate, and you are suggesting that that's the rate at which the company have to give us returns before they participate in their, in the returns.
Sorry.
I just want to be sure that.
Yeah, no, I think, I get myself in trouble. I think totally. Meaning if, you know, if a private illiquid investment, you know, is down the capital stack as equity, you know, I think it's, you know, to get an 8 to 9% return, you know, I think it's not, I think you need to get paid, and the return target has to be higher, because there are other assets that get you there, and the uncertainty is higher. Anyway, sorry if I described that.
Okay, no, I understand. I just want to be sure we all
Yes,
are
sir.
on the same page.
Yes, sir.
Okay, well, thank you. That was an enlightened presentation, and thank you all, Mr. Fields and Mr. Rita. We're pleased that you could be here to share your outlooks, and your perspectives are very valuable for us to hear. And thank you, Lauren and John, for your participation. Good job. And Karen?
Thanks, Henry. At this time, we are going to take a quick 15-minute break, so we'll see you all back here at 3:15 for our next session.
Thank you.
Thank you.
Always a pleasure, bud.